Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and we're here for another episode of the Financial Freedom Secrets Show. And we're continuing with our playbooks, masterclasses, where we're taking you through each of the pillars of our signature system of how we've helped our clients build over $3 billion in combined wealth. Over the course of the last 3 episodes, we've gone through the millionaire mindset system, helping you lift those invisible ceilings that are getting in the way of you stepping into the version of yourself that you need to be in order to create true financial freedom. We've gone through the real roadmap system of helping you work through how do you actually do financial modeling? How do you get clarity on your goals and your aspirations? How do you run the what-if scenarios? And how do you work out the optimal path to be able to achieve your goals? And then we went through the simple strategy system of taking you through all of the tactics that we have available and how we implement those tactics in order to help our clients get on track for financial freedom faster and squeeze as much financial juice as they possibly can. That encompasses the define aspect of our system. We're now going to be progressing into the create aspect of our system, which is where the magic really starts to happen. The rubber hits the road. So let me share my screen and I'm going to run you through this system. Now, if you want to get access to all of the playbooks and access to all of the materials, along with access to my 8 international best-selling books and all of our best calculators and tools, jump onto wealthhealthcheck.com. and make sure that you complete the financial performance scorecard. It's going to give you a customized report specific to your situation and help you identify the low-hanging financial fruit across your business profitability, across your tax optimization, and across your wealth creation and financial freedom strategy. It'll take you just 5 minutes and you're able to get all of the resources as part of that as a bonus. So let's get stuck in. So what we're talking about today is the Sustain Surplus Playbook. This is our no bullshit guide to financial freedom for business owners who refuse to live like peasants. Because this is the wake-up call. Like, you started a business to escape the rat race. Instead, you ended up creating this golden prison with prettier bars, right? The brutal truth is that most gurus won't tell you this. 94% of businesses never sell for a profit. The average business owner earns 40% less per hour than they deserve. And then when you factor in the stress, the risk, and the investment that they make, not to mention all of the reinvesting back into the business, once we do those numbers, it means that only about 6% of businesses are actually sold for a profit once you factor all of that in. And what that means is that you are not building wealth. You are building a cash-eating monster that demands more feeding each and every single month. But this is what separates the financial winners from the losers. It is not how much you make, it is what you do with what you keep. So this playbook is going to show you exactly how to extract maximum surplus from your business and your personal finances, and then systematically convert that surplus into lasting wealth. This is no fluff, this is no theory, this is just proven systems that work. And on average, our clients increase their household surplus by about 20 to 30% as a result of implementing this playbook. This is absolute gold. So this is our signature system that we call the Wealth Mastery Machine. And ultimately, this is our proven process that we've used to help our clients build over $3 billion in combined wealth and ultimately create financial freedom a whole lot faster. So we're now talking specifically around this Sustain Surplus piece. So let me run you through the surplus reality check. There is a reason why most business owners stay broke, despite making good money. Like, most of the clients that we work with are running 7- and 8-figure businesses. And there are 3 financial killers. 1, they don't have a plan. Like, you've replaced financial planning with wishful thinking. You're like, yeah, I'll get there. I'm just going to keep working harder. 2, no cash. Like, there's cash flow bottlenecks that exist in your business and your personal finances that end up bleeding you dry. And 3, there's no consistency because you treat your business like an ATM. And the uncomfortable truth here is that if you're making $1 million in revenue with 13.3% profit margins, that gives you $133,000 before tax. After taxes, after living expenses, after business reinvestment, you're left with scraps. Like, it's not enough in order to live comfortably and build wealth anymore. Meanwhile, you're stressed, you're overworked, and you're no closer to financial freedom than when you started. So this is what we're trying to solve. So here is the surplus revelation. Here's what changed everything for me, and it's going to change everything for you as well. Surplus is the only wealth creation lever that you have direct control over. You can't control market returns. You can't control property appreciation. This is not some crypto moonshot. It's your surplus. If you master your ability to manufacture and increase your surplus, then you can ultimately work towards increasing your surplus by, in some cases, upwards of 40% without having to earn another dollar. That's an extra potentially $490,000 over 30 years if you invest that money at an 8% return. So this is the value of the opportunity here. So let's talk about the hub structure. This is what we call the cash flow command center. So here's the problem with your current system. Your money is scattered across accounts like a broken piñata, okay? You have no visibility, you have no control, you have no structure. This chaos is costing you thousands every month through what I call cash flow creep, okay? So the solution is what we call the hub account system. This is not theoretical. We've tested this with thousands of clients. Some of our clients have increased their surplus by 40% or more. So let me talk you through it. So first things first, you have your net income, which is usually coming from your business by way of salary, by way of bonus, or by way of profit share, okay? You may also have net investment income if you've got investment assets that are positively geared, okay? All of that net income comes into the hub account, and our hub account pays for all of our fixed expenses. So this is the mortgage repayment, the bills, the groceries, anything that's a necessity of life, because we do not overspend on necessities. They're expensive, but we don't overspend on them. We spend what we need to spend, and we shouldn't be worried about that. Now, first and foremost, we want to ensure that we build an emergency buffer in the hub account so we wean ourselves off needing to use credit cards, okay? Because what we've proven is across our client base of those who use a credit card for their personal finances, on average, spend about 15% more than those who use their own cash. This is a behavioral finance principle that has been heavily researched called mental accounting. I'll cover this in the next episode. So what we want to do is we want to create your own credit card facility with your own cash. So we want to have an emergency buffer in this hub account of between 10 and 20,000. Whatever number you pick, that becomes your new zero, okay? So we should never have the account go below that level. Now, the reason behind this is that we have a debit card linked to this hub account. So when you go to the grocery store and tap the card, you never have to worry about that transaction going through, okay? Because once again, we don't overspend on fixed expenses. Next, we set up two separate spending accounts, one for you, one for your partner, with their own separate debit card. And we set up a weekly automated transfer. I personally prefer to do that on a Friday for your weekly play money. So for most of our clients, it's a number between $200 a week and $500 a week, okay? This number is ultimately up to you, and we will drip feed it weekly. The reason for it is because this gives you a segmented amount that where you're most likely to do the damage. And what happens is each week, there is one of three outcomes. One, it's enough, or maybe you accumulate your savings. Fantastic. And you can then build that up to buy something bigger, or you can contribute that to surplus later. Two, it's not enough. And let's say by midweek you run out of your spend money and you realize that you've done that. So then you defer any of your future personal financial decisions until the next week. Or three, you don't have enough money. You really want to buy something. So then you have to transfer it from the hub account and top it up. And we usually have an accountability system between you and your partner where you send a quick text saying, hey, I want to buy this thing. I don't have enough in my spend account. I'm going to do a one-off transfer and then we'll play catch up and top that back up over the next few weeks, right? The difference here is that it creates personal accountability. You have had to make a proactive decision before the purchasing decision took place, and as opposed to just tapping your card and not even thinking twice about it. We have found that this shifts behavior substantially because of a behavioral principle called Parkinson's law. We'll talk more about this shortly. So what we often find for our clients is that we calibrate this number over a period of time. So you might start at 200 and then you're finding you're constantly having to top it up week after week. So then you increase it to 300. And then we end up finding a rhythm. We find an amount that is comfortable for you. The important rule here is whatever you have, your partner has, and vice versa. Okay. Even if you don't spend the money, we want to make sure that there's a quality at play. Next, we want to plan for the things that sneak up on us over time. So we've got lumpy bills. So these are bills that fall quarterly, half yearly, or yearly. It's things like rates, water. It's about insurances that we pay annually, school fees, these kinds of things. We want to ensure that we have an account that we can put money aside and save for these things in advance. So when the bills fall due, we can pay them. Better yet, many of these bills that we're paying monthly for convenience, we could potentially convert to annual and get between 8 and 12% return because they give us a risk-free deduction. They reduce the premium or they reduce the cost because you're paying for it in advance. So this is an 8 to 12% risk-free return. And this is a really smart decision that wealthy people do. We then set up a holidays account. Same reasons. You have an annual holiday budget. Sure, we might break that up from a couple of small trips through the year and one big trip, but we want to make sure we work out the budget and we save for that monthly automatically. So then when the holiday comes around, you've got the money there ready to go. And then lastly is the war chest. We want to have a separate account for unallocated surplus because we've been able to prove that across our client base, there is a subconscious threshold where your spending behavior changes. So if we see in that hub account that there is 20,000 or 50,000 or 100,000, for many people, there is a number that shifts their spending behavior and gets them to be less careful and more reckless around their spending decisions. So if there's money that we're saving for say a property deposit or something big, we want to make sure that it's out of sight, out of mind. Now, the important point here is that if you've got a mortgage, we want to make sure that all of these accounts are offset accounts if we can, because we want to make sure that this money isn't just sitting around idle, that it is working for you. And the key thing here is when the net income comes in, we've got our hub expenses, our fixed expenses accounted for, spend one and spend two accounted for, bills accounted for, holidays accounted for, and then the war chest accounted for. It now means we only need to focus on one number, which is the balance of the hub account. If the hub account's going up, it means we're in surplus. If it's staying about the same, it means that we're at parity. And if it's going down, it means that we are in deficit. And it makes it so much easier that you never have to run a budget ever again. Absolutely game changing. So let's work through this. Hub account, all income comes in here first. We build the emergency buffer. It's the distribution center for all of the other accounts. The bills account, this is the necessity engine. All of the lumpy bills that we need to pay for over time. We don't touch it for discretionary. Spent. Two identical accounts, one for you, one for your partner, equal but weekly transferred regardless of who owns more. This is guilt-free money for coffee, entertainment, personal items. This is the secret to ending money fights forever. No more bickering. Holiday account. Anticipation builder, monthly transfer for your vacation funds. Separate from your emergency money, it's pre-planned and it's pre-funded fun, okay? War chest, self-funded self-insurance policy. We want to build up 3 to 6 months of expenses ideally, and we customize this to your specific risks. So this is the foundations of wealth building. So there's a psychological genius behind the system. People fail with money management because they rely on willpower. Willpower is finite, structure is infinite. So when you can see exactly how much money you have for each purpose, this eliminates the mental gymnastics that leads to overspending. You're not borrowing from your investment account for dinner. You're not wondering whether you can afford that vacation. Everything has a place. Every dollar has a purpose. So I've run you through an implementation protocol. We audit the current disaster, see where you're at. We list all of the accounts that you have. We identify the purpose for each. We calculate the true monthly surplus. We set up the hub structure. I'll run you through exactly what that looks like. We set up the automated transfers, and then we calculate the numbers for the fixed expenses, the personal spending, the holiday fund, the war chest. And we automate it, right? And ideally, we just review that over time through the behavior modification. We make sure that we stick to the purpose, and this takes a bit of a rhythm. For many of our clients, it takes 4 to 6 weeks to find themselves in flow. We don't borrow between the accounts. We track the spending from the baseline data, and then we adjust the amounts based on reality, not wishful thinking. And then by week 4, we're optimizing. We can review the actual spending versus planned. We can adjust our automatic transfers, and we can celebrate the immediate clarity and control that comes from this. So let's talk about part 3. This is the war chest strategy. This is why most emergency funds fail, because most financial advisors just tell you to save a generic 3 to 6 months of expenses. It's useless advice. Like 3 months for whom? 6 months for what scenarios? Like what expenses? Current lifestyle or bare minimum survival, right? We want to create a customized war chest approach. So we want to consider the personal risk assessments. Like what are the things that keep you awake at night? Car breakdown. If that happens, what's that going to cost? 3 to 8,000. Home emergency. Hot water. Air conditioning system needs to be replaced, 5 to 15,000. Medical emergency, 10 to 50,000. Family crisis, so if you've got family overseas that are getting older, maybe we want to have 2 to 10,000 for that. Business cash flow gap, 2 to 3 months of operating expenses. Economic downturn buffer, 6 to 12 months of living expenses. Once again, this is completely up to you, but we want to look at the formula of monthly living expenses multiplied by 6, plus business operating expenses multiplied by 3, plus a specific risk buffer, or just the sum of all of these specific personal risks that you may have. Like for most of our clients, this number is between $75,000 and $200,000 that they need to have available in cash. Once again, it doesn't just sit there idle doing nothing. We want to have it in offset working for us. So what we've got to understand is there's a psychology around financial security. Nobody tells you about emergency funds. It's not just about the money. It's about psychology. Like when you know you can handle whatever life throws at you, you make better business decisions. You don't take desperate clients. You don't accept terrible terms. You don't stay awake at 3 a.m. worrying about cash flow. Confidence is profitable. And there is a fundamental shift of once we've hit that war chest balance and your strategic decision-making ability. Let's talk about the investment operating system. So we want to make sure that we're trying to fill 3 wealth buckets. So once your war chest is funded, every surplus dollar needs to get allocated across the 3 investment buckets. So the short-term bucket is defensive investments, high-yield savings accounts, government bonds, or an offset account against your home. This is about capital preservation with some growth if possible. We want to preserve that capital against inflation. But we want to keep liquidity. Medium-term bucket, income-producing investments, dividend-paying stocks, real estate investment trusts, high-yield property. The purpose of this is to create regular income with moderate growth. And then the long-term bucket is 15 years plus. These are growth investments, growth stocks, private equity, potentially developing property or capital appreciating property. This is about maximizing your capital base and allowing compounding to work on bigger numbers. So the allocation strategy really depends on your timeline to financial freedom. We've covered this in more depth in the previous episode of how you go about creating your one-page wealth plan and defining how much you need to put in it. But here's some kind of general rules of thumb. If you're a conservative, low-risk person, we find that people put 60% in short, 30% in medium, and 10% in long. We've then got balanced, so this is kind of like a moderate risk, 40% short, 40% medium, 20% long. And then aggressive, we usually have 20% short, 40% medium, and 40% long. I personally am more towards that growth, aggressive bucket, and in fact, I try to keep less in cash than 20%. It's usually more about 10%. So then the next part is debt leverage decision. Like, here's the part that most people get confused about with debt. They think all debt is bad, and we're going to talk about this more in the next episode. But there's bad debt that we use to buy depreciating assets. They've usually got high interest rates. There's no real tax benefits. This even includes your principal place of residence, okay? Because you're paying for that debt in after-tax dollars. Good debt is against appreciating investment assets, may have lower interest rates, and is tax deductible. So this is investment property. These are business loans, okay? So the whole idea here is that if you can borrow 6% and invest at 8+% with reasonable certainty, then leverage actually is providing you with an arbitrage opportunity. So what we need to understand is our cost-benefit analysis of investing versus debt and utilize that as part of our overall strategy. We'll talk about that in the next episode. So let's talk about the wealth milestone system. So there was a concept that we developed called the financial pyramid, and most people compare themselves to others and end up losing motivation. So instead, you need to compare yourself to where you were yesterday, right? This is your race. Comparison is the thief of joy. So 1, financial battle. You're spending more than you earn. You're burning through savings. You're accumulating debt. You're essentially in survival mode. And if you're there, the goal is to get to level 2, which is financial comfort. We live comfortably, but we have no surplus. And we're treading water financially, which means we're not progressing towards our goals. Level 3 is financial growth. We've got a profitable business. We've got good household surplus, and we're using that surplus to actively build wealth, which could be investing, could be paying down debt. It could be both. Now, financial freedom, level 4. It means your home is paid off. You've got enough passive income to choose what you do with your time. And ultimately, you are at that point where you don't have to work anymore if you don't want to. The important part there is getting the home paid off and knowing how much passive income that you need in order to be financially free. And then level 5 is financial abundance. You've got more than what you need. And you can never spend that money, right? So you've got the ability to give back to family, friends, charity, community, causes that are dear to your heart. And this is where true generational wealth is built. So what we're trying to work out is, where are you now? Out of the 5 stages, where do you ultimately want to get to? And then what is the next logical stage? Because you can't go from level 1 to level 5. It just doesn't happen. You've got to go to level 1 to level 2. And then you've got to firmly cement yourself there and then start working towards level 3. This is really important because your surplus is going to be the main contributing factor to scaling these stages. So what we do is we define what we call the 6 wealth metrics. These are the numbers that we track monthly. So active income, how much have you earned from work? Personal surplus, what is left over after expenses. Cash, liquid savings and your war chest. Investments, all of your appreciating assets. Debts, all liabilities. And then your net wealth, which is your assets minus your liabilities. And the point here is that what gets tracked gets measured, what gets measured gets improved. If we track these money milestones, it is going to make it a whole lot easier for you to know where you need to focus your attention. So here are some benchmark targets. Financial growth targets. We want a 20% or more surplus rate. So if you're earning $10,000 a month net, we want to make sure we've got a surplus of $2,000 a month, okay? We want to work towards building a 6-month fully funded war chest. And we want to automate or at least systematize the investment contributions. Now, the financial freedom targets. We want to have the home mortgage eliminated, okay? It's really important, we believe, for our clients to own their home at some point, and the goal is to have that fully paid off because that drastically reduces the amount of passive income you need once you have that asset that you don't need to pay dead rent into. Cool? Then the wealth target for our clients, we aim to build at least $4 million in investment assets, and that assumes that if we have a 5% withdrawal rate, we can have a $200,000 annual passive income. And we want to make sure we've got multiple income streams. So that might be business, shares, property, both residential and commercial, making sure that we've got a good diversified range. So let's link this to business. So the next part here is the business profit connection, reverse engineering your wealth goals. So most business owners think I'll make more money and then I'll invest it. But wealthy business owners think I need X amount of surplus to reach my goals, therefore I need Y profit, and therefore I need Z revenue. So how do we calculate this? We define your desired lifestyle cost. So let's say it's $200,000 a year. Add your investment goal. Let's say it's $100,000 a year. So you need $300,000 after tax. Let's assume that you've got a 35% tax rate. I think we can do a little bit better than that, but being super conservative, that means you need to earn $462,000 gross, which means the business needs to profit $462,000 or more. Like, depending on how much you want to have available to reinvest back into the business, you may need to adjust that. Now, let's assume you've got a 20% profit margin. You need a $2.31 million revenue in your business, right? And we can obviously adjust these levers. Like, this is a real target. This is not some arbitrary 7-figure vanity metric, right? It's allowed us to take the outcome that's important to you and reverse engineer it into the activity required to get there. So let's talk about the profit mastery machine. So this is the equivalent version of the hub structure, but for the business. And the idea here is that we need to operate on these principles. Revenue focus, fewer high value clients, right? It's far easier for us to have higher value clients and fewer of them than having lots of clients and that pay us a smaller amount of money. Next is a margin focus. We need to focus on premium pricing and efficient delivery, right? We want to be premium in the market because premium businesses can navigate all economic times and they have more margin for error. Cash flow focus, fast payment terms, and we want recurring revenue. And then profit focus, everything should be focused on serving profitability, no vanity metrics. So similar, the structure is we've got a revenue account. This is our business hub. It receives all income and distributes between the other accounts. The difference here is that there is no expenses from the business hub, nothing from that account. We have a GST or a sales tax account. Some of our clients just have a single tax account for all tax, but just to explain the logic, we want to make sure we set aside money for GST or sales tax. Then we've got cost of sales. We have a separate account for cost of sales, so we can put aside money for contractors and for our suppliers. And so we go income minus sales tax minus cost of sales equals our real revenue or our gross profit. From that gross profit, we can now put that into 4 buckets. We've got our profit account, which is you deserve to be paid 2 paychecks for being a business owner. You deserve to be paid for working in the business, and you deserve to be paid for the risk that you take for investing in the business, okay? Tax, PAYG, super corporate tax. Once again, you could also put our GST in this account as well. Owner's pay. This is paying yourself enough to have a consistent income to maintain your lifestyle. We want to segment this because so many business owners don't pay themselves what they're worth. And then we've got OPEX or operating expenses. This is your fixed expenses like employees, rent, bills, etc. Many of our clients also pay their debt from there. Some of our clients choose to carve that off and have a separate debt repayment account, okay? So the goal here is that this allows us to have, once again, complete clarity around where our money is going, and it ensures that we are focusing on optimizing for profit because we do it in this order: income, sales tax, cost of sales, profit, tax, owner's pay, and OPEX. OPEX is always last because it forces us to be resourceful and it ensures that profit is presupposed. And the goal here is that we pay to our hub account from the owner's pay account, and then we want to build up the profit account to have ideally 3 months of cash to expenses. So if it's 3 months, we pay zero profit, or if it's less, if it's 3 to 6 months, we distribute 50% profit. And then if it's above 6 months, then we distribute 100% of profit. And that goes into the hub account after we've accounted for the tax. So the goal here is the monthly profit review, revenue versus target, your margin analysis by product or service, your cash flow position, and your profit distribution plan. So let's talk about part 7, the behavioral mastery system. So Parkinson's law on your money. Work expands to fill the time available. So the money version of this is spending expands to fill the income available. This is why most lottery winners go broke, okay? Why business owners making 500 grand or $1 million a year still live paycheck to paycheck. Why you can't seem to save any money no matter how much you earn. So the goal here is we want to create an automated discipline solution. We've already spoken about willpower fails, systems succeed. So this is the pay yourself first protocol. Income hits the hub account. We automate transfers executed immediately. The investment accounts are funded before you see the money, and the remaining money is used for extra stuff, discretionary spending. So this is the constraint philosophy. By artificially constraining your available cash, you are forcing efficiency. You can't waste money that you don't see, okay? So here's the review rhythm. This is what we take our clients through on a regular basis. So let me just show you this. So we've got weekly, 15 minutes, and really it takes only 15 minutes, guys. Check the account balances, review spending in personal accounts, adjust upcoming week if you need to. Monthly, calculate surplus versus target. Review investment performance, adjust the allocations if needed. Quarterly, 2 hours, do a deep review of the entire system, optimize based on 90 days of data, plan adjustments for the next quarter. It's really, really simple. If we average this all out, it works out to about 30 minutes a week. So let's talk about advanced wealth strategy. So tax optimization, business structure. Do we look at companies, trusts, individual trading? Do we look at income splitting strategies? Do we look at ways to optimize capital gains tax? Do we look at depreciation and deduction maximization? This is something that we should definitely be factoring into our cash flow strategy. Our investment structure optimization, negative gearing versus positive gearing, capital gains versus income focused, tax deferred growth strategies. How do we integrate this into estate planning, right? What about asset protection? 3-layer defense, insurance. Do we have professional indemnity, public liability, income protection, life TPD, trauma insurance? Layer 2, structure. Do we have separate entities for different assets? Do we have trust structures where appropriate? Do we have director protection strategies in place? Then our layer 3 is our diversification. If I can just format this here, is asset class diversification. How do we make sure we don't have all of our eggs in one basket? Geographic diversification. We don't want to have a home bias of just investing in a particular area for property or just investing in Australia for the share market, right? And then time diversification. Wherever possible, we want to leverage dollar cost averaging to allow us to get access to the market at various points in time, which is where the hub structure really works well because we have that drip feeding strategy each and every single month. Now, the exit strategy. Exit strategy is really important because this is where we get significant cash flow injections that allow us to accelerate our strategy. So we really need to consider this. Business exit planning. We need to understand the valuation optimization. We need to look at the sale preparation timeline. We need to look at management transition, and we need to look at wealth preservation post-sale. For example, if we structure this correctly, there is an opportunity for us to get access to the small business CGT tax concessions, and as a result, in many cases, you can pay zero tax on the sale. We've had clients who've been able to sell their business for up to $5 million and pay zero tax on that transaction. If we didn't plan that effectively, that could have been up to a $500,000 or more tax bill. So this is a significant amount of extra cash flow if we plan this correctly. Succession planning. This is also about cash flow for your beneficiaries. So estate planning documents, educating your beneficiaries, having wealth transfer strategies, having family governance structures in place. These kinds of things are critically important because we've seen money evaporate very, very quickly if people don't have these things in place. So here's the implementation roadmap. Month 1, we want to set the foundations. Week 1, complete the audit, set up the hub structure. Week 2, implement the automated transfers for the behavior tracking. Week 3, establish the war chest funding and investment account setup. Week 4, first full month review and system optimization. As I mentioned, it takes about 4 to 6 weeks to get yourself in the rhythm. Month 2, optimization phase. Analyze the first month of data and adjust the allocations. Week 2, implement tax optimization strategies. Week 3, set up the investment automation and portfolio construction. Week 4, business profit optimization review, because we're at a point then when we can identify, do we actually have enough cash flow coming in to allow us to live a great lifestyle and have great surplus? And in many cases, it means we've got to increase profit. And then month 3 is advanced implementation. This is asset protection review and implementation, estate planning and succession planning, advanced investment strategies, and the quarterly system review and planning. And this is where we find ourselves in what we call our on-track management and review phase, where we optimize and improve over time. And then really over 4 to 12 months, it's about mastery. It's about that monthly optimization. It's the quarterly deep dive analysis. It's the annual goal setting and strategic refinement. And it's the continuous education and strategy evolution. Like, this stuff is not set and forget. You've got a complex situation. You've got things that are ever changing. You've got goals and aspirations that shift and change. And the great thing about this structure is that we can adjust it to suit your trajectory and what it is that you're trying to achieve. So the big part here, the mindset shift from scarcity to abundance. The fundamental principle here is that traditional wealth advice is still built on scarcity, shrinking yourself wealthy, saving every penny, denying yourself pleasures, deferring gratification for 40 years. That's employee thinking. As a business owner, you can control your income. The question isn't how can I spend less, it's how can I earn more while optimizing more of what I keep. So the abundance formula is high income plus high surplus rate plus smart investment strategy equals accelerated wealth. This is the epitome of my life philosophy of live for today and plan for tomorrow. You don't have to choose between enjoying life now and being wealthy later. You can have both if you're smart about it. So the balance is you need to fund your current lifestyle fully, you need to fund your future goals systematically, and you need to increase the income to allow you to support both. This is how you have your cake and eat it too. So let's think about the compound effect of this. Like, small improvements compound dramatically. So if we improve your surplus by 10%, that is 40% more wealth over 20 years. If we can increase your investment returns by 2%, that's 67% more wealth over 30 years. If we start 5 years earlier, it's 150% more wealth at retirement. The math is merciless. You need to start now, you need to optimize constantly, and you need to compound relentlessly, okay? So the next steps for you today: complete the financial audit worksheet. Work through this. Go through and open the required bank accounts. Set up the automated transfers and then calculate your war chest target, okay? This week, implement hub structure. Begin tracking all of your spending. Set up the investment goals and timelines. Schedule the monthly review time. This month, optimize based on real data. Implement tax strategies. Set up the investment accounts and create quarterly review process. This year, achieve your war chest target. Optimize business profit margins. Implement the advanced strategies, and then as a result, you're building wealth systematically. And here's the bottom line. Financial freedom isn't about making millions. It's about keeping and growing what you make. Most business owners will read this and do absolutely nothing. They'll bookmark it, they'll save it, and they'll continue living paycheck to paycheck despite making good money. Don't be like most business owners. Your surplus is the only wealth creation lever that you directly control. You need to master it, and when you do, you will master your financial destiny. The system is actually pretty simple. The results are predictable. The choice is yours. Get started today. Remember, you didn't build a business to stay broke. You built it to get rich. This playbook shows you exactly how. Now, execute. The best time to plant a tree was 20 years ago. The second best time is now. Your future wealthy self is waiting. Don't keep them waiting any longer. So guys, if you'd like to get some help implementing this playbook, this is what we do with our clients every day. If you go have a look at our client wins and case studies, the vast majority of those talk to the value of the hub structure and the profit mastery machine and the extra wealth that has allowed them to extract as a result of that. So if you'd like to get some help, feel free to go and jump onto wealthhealthcheck.com.au, complete the financial performance scorecard, get your customized report, which will help you identify exactly where you need to focus your attention. And then let's make a time and have a conversation around how we can help you implement these cash flow systems, start extracting more surplus, and then accelerating your path to financial freedom. Otherwise, join me on the next episode of the Financial Freedom Secrets Show, where we're going to go into the debt destroyer system, where we're going to talk through the strategies and methodologies that we have around extinguishing bad debt quickly and using good debt in order to accelerate our wealth a whole lot faster. Look forward to catching you then. We'll see you.